Good morning, Andrew, Michael. Dornbusch download number 53. As you can tell, we're really excited here today.
Chomping at the bit.
Chomping at the bit. Happy to be talking to you, our happy followers. 401 of you. Thank you all, 401 of you, including Mum. Hi, Mum. Does your mum follow us on Facebook?
I don't know. I'm not on Facebook myself, so
Well,
I'll have to get on
the homework.
Absolutely.
Nick and Janet. Onto Facebook.
Letting the side down for sure.
No, in all seriousness, not a lot to be smiling about at the moment. It's, I think you and Dan cursed us last week. We've dropped like 7%. That's why I'm back, trying to get the market back up again, because it's not in a happy little space at all at the moment.
You're right, Andrew. Yeah, been another tough week, hasn't it, out there? And really not a great deal of light at the end of the tunnel at this point in time. A lot of it, macroeconomic based, of course. We've sort of run our reporting season, which all in all wasn't fantastic. I think I was just reading there this morning on an aggregate level, earnings per share were down about 2%. Bit softer, of course.
And yet dividends were up 2%.
Yeah.
Go figure, earning less, paying more.
Yeah, absolutely. Yeah, no, there's got to be a catch-up point on that at some stage, of course, if things continue. But yeah, concerns in China, again, goings on in America, the European scenario still sort of dangling in the background as well. There's enough to keep people a little bit apprehensive at the moment.
But I think, to be fair, we've gone through 4 or 5 years where there's been very little volatility at all. And the share markets, by general nature, are volatile. So it's been this diminished volatility for a number of years. So partly what we're going through, yes, there's all those concerns, and some of them are justified, some of them aren't, as John Gilson's phone starts ringing, is that it's really just a lot of catch-up relating to that volatility taking place at the moment. So from that point of view, it's no great surprise. I think really, what people want to know is what they should be doing, and I think that's probably the tough one. So, Michael, you've got all the answers. What are we doing?
Yes, it is. It's a good question, Andrew. And I mean, ultimately, it always comes back to the individual investor. I think certainly from my point of view, and I'm sure I speak on your behalf as well, we're probably viewing this as still a hold, sit out, maybe pick up a few as better value sort of comes about. Sure. So, that's always, I guess, the optimistic, the glass half full viewpoint. But certainly if you're losing sleep at night, if the beads of sweat are starting to form on the forehead, look, take a bit of profit or a bit of money out, put it back in the bank, sleep a bit easier at night. There's no absolute right or wrong answer, of course, but I think certainly from my viewpoint, it doesn't seem to be GFC phase 2 at this stage, and it's unlikely to get to that point, we think. But again, an opportunity maybe just to keep chipping away and topping up a few whilst they're down.
And it's a tough one, isn't it? Because as you said, it's not GFC. GFC was whereby there was no liquidity and banks weren't lending to each other. It's the complete opposite at the moment. So it's not GFC-esque. This correction that we're going through is more concerned about global growth and therefore implications for Australia as well. Say you had a client that was more interested in trying to protect themselves on the downside, like, acknowledging that dividends are actually higher, that it's just a bit wobbly. What could they sort of use to protect themselves? Yeah,
well, I guess traditionally, Andrew, there's numerous derivative products that have been out in the marketplace for many years now, and, buying put options or going short CFDs, going short futures contracts, those sorts of strategies have been around for many years. But, for the day-to-day mums and dads, it's not an overly sort of straightforward process.
And expensive.
It can be, absolutely. So there's been a couple of products that have hit the market, certainly one more recently than the other one, but Beta Shares, the exchange-traded fund provider, has basically got an investment called Bear, and of course hence referring to a bear market, market's going down, which basically, is an inverse or has an inverse relationship to the general market.
So as the market's going down, these bear shares, which have the code surprisingly, bear, go up.
Yeah, absolutely, and it's a good way to get access to some sort of hedging capability within your portfolio. You buy and sell it like a normal share. Normal brokerage sort of costs are involved, but it's reasonably straightforward. These guys behind the scenes, Beta Shares, basically take care of the futures contracts itself, and let's face it, now it's still all derivative based internally, of course, but they basically short sell equity index futures on the pretense that, yeah, if the market goes down, they should get some upside in those futures contracts, and that's reflected back in a higher price of these bear securities.
But there's no dividend or anything like that. You know, it's got a sort of a retail front, if we can put it that way. So in other words, you can buy it on the stock exchange, but you're simply buying it, as Michael says, because if you think the share market will go down further, the way they're structured, it should go up. Or equally so, if the share market suddenly bounces back tomorrow, these things are going to tank. So that's what you've got to bear in mind. There's that sort of counter-cyclical argument with them.
Yeah, absolutely right, Andrew. And again, you know, the BEARs, the bears, you know, basically will reflect a one-for-one relationship with the market index, the ASX 200. So as you say, ASX 200 goes up by 1%, these will go down 1%, and vice versa. There's also strong bear, BBOZ, which is basically a 2-for-1 relationship.
Okay. So it's bear on steroids, basically.
Pretty much so, exactly right. So ASX 200 goes down 1%. In theory, a strong bear should go up by 2%. So bear in mind, something to maybe add to the arsenal, I suppose, in times of concern. And, you know, again, just a myriad of these exchange-traded funds that are out on the market these days that give you different exposures to all sorts of different things at the moment.
But in particular with this volatility, it might be something to at least talk to us about, see if it suits your circumstances, because as we're saying, you know, it sort of moves in the opposite direction to where share markets, which are going this way at the moment, might help sort of balance out some of the negative returns.
Absolutely.
So for the time being, we're really just saying talk to us. That's probably the key thing. You know, because as you said, some clients, you know, have got long memories from the GFC. Others are looking for opportunities like there. So, you know, please give us a call, send us an email, inbox us, and we'll certainly do our best to give you a hand. Anything else from you?
Nothing really, Andrew. Our GDP figures out later on today. Again, no real lights to be shot out there. 2.2%, I think, there is the annual expected rate. 0.4% for the quarter. Yeah, not looking great on that front.
If that's a negative number, we're going to test 5,000 on the stock exchange for sure.
Yeah, absolutely. Yeah, current account deficit, I think, blew out to 19 billion yesterday, as opposed to sort of 16 billion, which was the expectation. So
all this economic data is certainly more on the downside than the upside. But again, we keep coming back to the fact that companies are talking about paying better dividends, and if you've got a long-term view and you're comfortable with the ones that you're holding, take your dividends. But equally so, if you're a bit concerned about all this noise, have a bit of a chat to us and we'll figure something out.
For sure.
Till next week.
Thank you.